I'm Stacey Marie Ishmael, managing editor of crypto for Bloomberg News. And this is Bloomberg Crypto, a daily Bloomberg iHeart podcast. It's Monday, August 15th.
Breaking news at the moment, we are hearing that a province in China plans to raise penalties for crypto mining. Of course, this is a continuation of the mining crackdown that we've seen in China already. Inner Mongolia has banned cryptocurrency mining and declared it will shut all such projects by...
In late spring of 2021, China banned all Bitcoin mining as part of an ongoing crackdown on crypto in the country. In response, many Chinese miners packed their bags and headed to the state of Texas. Texas offers what I'll describe as a relaxed approach to regulation, a unique power grid, and relatively attractive energy prices, all things that seemed ideal for these miners looking for a new home. And then 2022 happened. The situation in Texas got slightly more complicated, to say the least. That unique energy grid is prone to power outages, made worse by extreme temperatures. Those extreme temperatures make it even harder to keep expensive mining equipment cool. And crypto miners are already facing financial difficulties brought on by declining Bitcoin prices.
So the miners actually, they are coping with the situation by selling some of the electricity they bought earlier back to the grid and at a premium.
That's Bloomberg reporter David Pan, who covers crypto mining. He and Ethan Vera, COO and co-founder of Luxor Technology, which is a crypto software and services company, both attended a recent Bitcoin mining conference in Miami. They join me now to share some takeaways from the conference, as well as their perspectives on how miners are trying to survive this complicated crypto winter. David, Ethan, thank you both so very much for being here. Now, one of the things I would love for us to do is just explain two things to our audiences. And David, I'll start with you. What is Bitcoin mining and why are there Bitcoin miners in Texas?
Sure. So Bitcoin mining is kind of like very industrialized, like scaled up industry right now. Bitcoin miners, they try to use very energy intensive and very powerful machines and to mine so-called like quote unquote mine Bitcoin, which means like they compute mathematical questions like to get a Bitcoin in rewards. And it's a very interesting process because it consumes a lot of energy. Mm-hmm. At the same time, you earn these digital assets, which is worth like millions of dollars. And that means millions of dollars in revenue for Bitcoin mining companies.
And one of the things that you've been reporting on is the fact that when China banned Bitcoin mining, banned crypto mining broadly, banned various types of crypto transactions, various of these miners left China and moved to other countries as well as to states in the US like Texas. Why was that? Why did they move to Texas?
First of all, I think a lot of the Chinese miners, they were very, very scared of any kind of like regulatory challenges because like when China banned crypto mining and the miners really didn't know where to go, they were caught off guard. And Texas actually, it has a very liberal crypto regulation. So that's actually one of the major reasons why Bitcoin miners were flocking to Texas. Secondly, I think it's because of cheap energy in the state.
I would say the relatively cheap energy, because energy prices are rising around the world. We have, a conflict in Ukraine, we have intense weather, but Texas, for a whole host of reasons that my colleagues have reported on, still offers fairly attractive rates, especially if you're benefiting from industrial pricing, which is what these miners get. Is that correct?
You also have like a very, very interesting energy market in Texas, also because of the way the energy market was set up and because there are a variety of demand response, so-called demand response programs where Bitcoin miners as large energy consumers in the state have the advantage to negotiate with the state's power operator ERCOT because they use a lot of energy, a lot of electricity from the grid.
Nearly all industrial-scale Bitcoin miners in Texas have shut off their machines. That's as the companies brace for a heat wave that is expected to push the state's power grid near its breaking point. The state has become one of the world's largest crypto mining hubs thanks to its low energy costs and liberal regulations on crypto mining.
So they can actually have these power purchase agreements with the suppliers and get a favorable rate in the first place.
Well, that all sounds great so far. So, Ethan, I'm going to ask you to talk a little bit about what some of the complications that miners in Texas, but really around the world, have been encountering in this market environment of falling crypto prices.
I'll start with the idea that they're getting squeezed in two directions right now. They're getting squeezed on lower mining revenue at the same time as higher cost. And so on the lower mining revenue side, that's largely a function of decreasing Bitcoin price that we've seen in the past few months here. Bitcoin obviously peaked above $66,000 there and now trading in kind of in the mid-20s range for the past few weeks. And then in tandem with that is their operating costs, which, as you mentioned earlier, is a function largely of electricity costs. And so as electricity costs rise in this macro environment, that's also causing decreasing economics. Miners, for the most part, and specifically in Texas, didn't lock in long-term power purchase agreements known as PPAs. The reason they didn't lock those in is because the forward pricing curve on electricity looked like it was decreasing over time. And so miners expected their electricity costs to decrease last year.
So when you
turned out not to.
Just to ask one question. So when you say the forward pricing curve, what you mean is like the projection for what energy prices would be over the next 12 months and on.
Yes, correct. So when miners were setting up shop in Texas last year, they were looking towards energy analysts to determine will power prices be lower in the future than they are today. Mm-hmm. And because the analysts told them that it would be lower, they decided not to lock in long-term rates and kind of play out to see how the market would trade. Ended up being that the trade went against them quite significantly there, and electricity prices are much higher today than they were last year.
David, one of the things that you have mentioned and, are reporting on is the fact that this exact type of forecasting that Ethan has described is getting harder and harder in the context of like climate change and just uncertainty around how are miners responding to this increased uncertainty in every element of their business?
So the miners actually, they are coping with the situation by selling some of the electricity they bought earlier back to the grid and at a premium. So recently we have seen Ride Blockchain, which one of the largest mining companies in Texas, do it through demand response programs and also other power purchase agreements. They were able to earn $9.5 million in power credits, and which is like a very profitable way to make money rather than mining Bitcoin at the time. So. Mm-hmm.
And Ethan, I'm going to throw this to you, given your background in investment banking and what you do at Luxor right now. Well, actually, tell us what you do at Luxor right now.
Yeah, that's a good question. Something I ask myself every day. But so Luxor is a focus on Bitcoin and cryptocurrency mining, and we run software and services. So we have a number of products, including a mining pool that represents about 6% of the Bitcoin network. We run an ASIC trading desk, so we buy and sell the specialized hardware used to mine Bitcoin. And my day-to-day is the COO, so keeping the lights on, working directly with our clients to help them grow their business and bring them onto our services, as well as a number of other functions on the operations and finance side of the business.
And given the work that you do, that gives you a pretty unique vantage point to understand what miners are dealing with, especially as it relates to financing, especially as it relates to, say, the costs of some of those machines. What are some of the financialization trends that you're seeing related to what David described about how folks are trying to make money in this environment? Yeah,
there's a few really interesting trends here. First is the ASIC-backed financing that started to come on the scene in early 2020, but has really proliferated in the past couple of years. And so that's allowed miners to leverage their balance sheet and the purchases they're making on equipment to get extra purchasing power. It comes with a whole new set of challenges as well. that we can get into a bit later probably, but that's one interesting trend. The second would be how miners are playing the energy markets. As David mentioned with the case in Riot Blockchain there, we noticed that the companies that are straddling the Bitcoin mining and energy side typically are much more defensible businesses than if you're only operating on one of those sides. The reason being that during times that Bitcoin mining isn't as profitable, which it looks like today, but energy markets are profitable, you can spend more time acting as an energy company. And then when that trend reverses, you can spend more time mining Bitcoin. So I think there's a rapid push for companies to become vertically integrated onto the energy side so that they can play into both markets there.
We'll be right back with more from Bloomberg reporter David Pan and Ethan Vera of Luxor Technology on the current state of crypto mining.
We saw what happened with regard to the natural gas system in Texas. Not only did that bring down electricity, and it obviously caused blackouts, caused enormous amounts of costs for consumers, it also raised natural gas prices in the entire region. And consumers in Colorado, consumers in Kansas, consumers in Oklahoma and elsewhere had to pay for that, and they're still paying for that, exorbitant rates, in large part because the supply and demand system was out of whack. There wasn't enough natural gas to go around.
That was Richard Glick, the chairman of the Federal Energy Regulatory Commission. He was speaking last January during a House subcommittee hearing on energy infrastructure efficiency. David, you've reported on, some big successes in terms of that, playing both sides. I think your story was about Riot Blockchain, which you said earned nearly $10 million in credits from, playing that energy market effectively. How does that work? Like, what does it mean to be on the energy side of things?
I wish I could give you a perfect answer to that question, but the nature of the energy market, especially in states like Texas, it lacks transparency. I think the way the energy market is set up is like we don't have a lot of visibility into the market.
One of the biggest criticisms of crypto mining, and I think it's a kind of a self-aware criticism. I no longer hear people involved in crypto mining try to argue that there is no environmental cost. What they try to defend is that environmental cost in different ways. But are any of these companies thinking about creating, more climate-friendly mining operations? And what would that look like from your perspective?
So I think the public companies that are listed in New York Stock Exchange, Canadian Stock Exchange, etc., have a lot more pressure from shareholders and generally stakeholders to become more environmentally friendly. And so we have seen a trend in the past year and a half of mining companies moving away from fossil fuel-based energy sources to renewable. That transition doesn't happen overnight because there are a lot of kind of legacy mining farms set up on power plants fueled by coal and natural gas. At the same time, there's been organizations set up like the Bitcoin Mining Council where there's peer pressure from other miners to use renewable and ESG-friendly power sources because it really puts a bad light on the industry, on everyone overall. And so if one company uses fossil fuels, the rest of the renewable energy companies will put pressure on them. So I would say that's very prevalent in the public markets. Private, not as much, just given they don't have as, a lens on them like the public codes do. Also, overseas companies, I would say, are less focused on that than we are in kind of North America, Norway, and some of the Western world.
Got it. Thank you. That's very helpful. And then, David, just a last question for you. You attended a mining conference last July, so July 2021. Then you attended a mining conference this July in 2022. What was your biggest takeaway about what, if anything, had changed in that time?
I think my biggest takeaway is just the general sentiment of the conferences. Last year people were so excited. You can see hope in people's eyes because that was 2 months after the China ban. So people were scrambling to search every corner literally for machines to mine Bitcoin. But this year is a lot of companies offering hosting services, which means they have the machines, they have the infrastructure, but they don't want to mine the Bitcoin themselves. And they were looking for people who can take the risk, mine Bitcoin. So please come to my site and mine Bitcoin. So you'll see this kind of a very big shift in terms of risk appetite, risk tolerance, and also people's outlook on Bitcoin prices. It seems like if you are scaling back if you are kind of like trying to pass the cost to a third party who is willing to mine Bitcoin in the near future, that means like you have a bearish outlook.
Right.
Yeah.
And Ethan, is that sort of short-term bearish outlook consistent with what you're seeing on your end?
It is. We've been operating Luxor for 5 years, so we've seen a couple of these cycles now. So I wouldn't say this bear market is much different than the one we saw in 2019, 2020, where a lot of the new entrants get a bit rattled about the decreasing mining economics and skittish. So I think there certainly will be a lot of mining companies or prospective mining companies deciding not to build a business anymore, given the economics. But the ones that do have conviction will be able to place a large bet now. And if a bull run ends up coming about in the near term, then they'll profit from that. So I think the high conviction miners are the ones that have profited in the past few cycles, at least from our perspective.
Terrific. Well, thank you both so much for joining us on the Crypto Podcast. Really appreciate you taking the time.
Thank you for having us.
You can find more of David Pan's reporting on the Bloomberg Terminal on Bloomberg.com or follow him on Twitter. He's at DavidPan_1. On the next episode of Bloomberg Crypto, in late July, allegations surfaced that some North Koreans were plagiarizing online resumes and tricking companies, including crypto companies, into hiring them for jobs. It's all part of a broader effort to raise money for North Korea's government weapons program, and it could also help the authoritarian nation evade global sanctions. But how did North Korea get so good at tricking crypto employers? And what does this all mean for the security of crypto companies? To better explain, I'll be joined by Bloomberg reporter Jeff Stone. This is Bloomberg Crypto, a daily podcast from Bloomberg and iHeartRadio. For more shows from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts. Send us your comments, questions, or suggestions for the show to crypto@bloomberg.net, or find us on Twitter, we're @crypto. The supervising producer of Bloomberg Crypto is Vicky Vergolina. Our senior producer is Janet Babin. Our producers are Mohammed Farouk and Sharon Barrero. Associate producer is Zanab Siddiqui. Desta Wonderad is our engineer. Original music by Leo Sidran. I'm Stacey Marie Ishmael. We'll be back tomorrow.